Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So, the last part of this paragraph is interesting, and this is why the candles are so effective, because it gauges the psychological analysis of the investor, and I would add the term or trader, becomes an important factor. And this is what the candles do. They help us gauge the psychological shifting between the bulls and the bears. Case in point, and it's great if you remember the names of the candlestick signals. You don't have to. Some of you may have my books on a knowledge level from 1 to 10. I tell people my books will take you to 1 or 2, but my books, I have about 30 or 35 candle signals. But what I do now in my more recent educations really focus on maybe 15 of them because they're much more common and, from my experience, much more accurate. But even if you don't remember the name of the candle lines, I think what you will pick up is the visual depiction of what the candles are relaying about the psychology of the market. So, for example, here we have a hammer. That's a candlestick with a very long lower shadow. And by the way, it should come after a downtrend. And the lower shadow should be twice the height of the real body, because we want to see a sharp bounce back. See, the market opened here. Now, at some time during the session, this could be a 5-minute chart, an hourly chart, a daily chart. At some time during the session, the market sold off. And if it was weak, it being the market was weak, whatever the pair you're looking at, if it was weak, it should have closed at the lows. But instead, the bulls had enough wherewithal to propel the market, in this case to close at the highs. Or even if it's a black real body, to close it over here. So we're seeing in this one session that there's a shift where the bears are getting a little bit more nervous. Why? Because the market smartly sprung back off the lows, and the bulls are getting a little bit more confident. And this is how the candles help us gauge those potential early reversals in 1, 2, or 3 sessions. Now, the hammer, no matter what market you trade, whether it's Forex or non-Forex, looks the same. When we look at the double candlestick patterns in a couple of minutes, we'll see how they look different between Forex and non-Forex. So here we have a hammer, and once again, the green real body is the same as a white real body, okay, and this is the same as a black real body. So the hammer, the low of the hammer should become a support area, and even if the market breaks under it, shown in the red arrow I just drew, it's still valid support. The market has to close under it. So what's nice about an option is you could, the challenge with having a stop on a close is you just don't know how far the market's going to go under the support area. And that can be very painful if you don't have an option. But if you have an option, once again, because of the delta, depending on the delta you have, even if the market does continue lower, the threshold of pain will not be, the pain will not be as intense because you don't have a 1-to-1 loss. And that may give you enough ability to, if the market does bounce back, to still be in the long, let's say a call option position. And of course, if the market does close under here, you may think about scaling back on longs. One of the great things with candles, and I know Steve emphasized this a lot, is the ability to define risk. I think Steve says that the first thing you should do when you do a trade is think what your risk is or what your danger point is. And so, for example, if you're buying on the hammer, the low of the hammer based on a close, that is the price that says you're wrong. The market, could actually sell off after the hammer, but as long as it's holding this as support based on a close, the long position is still the right way to be in. But if the market closes in below the hammer, if you're long, you're wrong. Okay? For almost all the bullish candlestick signals, we have a bearish counterpart. And here we have it's called a shooting star, long upper shadow, small real body, bottom end of the trading range. The upper shadow should be twice the height of the real body. Okay, and once again, it's great if you remember the name, the shooting star. It doesn't matter if you remember the name. Look at the visual depiction here of what's going on. The market obviously is rejecting higher levels. What does that mean? The Japanese would say it's signaling trouble overhead. Okay, now I have about a dozen Nison trading, what I modestly call Nison trading principles. And number 4, and I referenced this early on in the seminar when we talked about the construction of the candlestick chart, that the more signals we have joined together, the more likely reversal. So whether it's a group of candle signals or a Western signal or a candlestick signal, all converging at the same support resistance area, what that does is increase the likelihood of the market turning. And this was a cover story that they did about me a few years ago in Active Trader. And the reason I wanted to show you this, by the way, I did try again to put Tom Cruise's face on my body, but they just wouldn't do it. But the reason I wanted to show you this is because they came up with the title of the cover story. And they got that because I just talked so much about the importance of merging, of the synergy between East and West. And that's what we're going to look at in the next slide. Okay. So here in the dollar, the Canadian dollar, U.S. Canadian, we have a shooting star confirming a resistance area. This is when you start getting more aggressive on your option trade. You know, maybe a deeper out of the money put. You know, this to me would be a directional trade. I wouldn't be fooling around with a spread here. Okay. The more confidence you have in the trade, the more aggressive you can become on the trade. Of course, you know, again, there's always a stop-out level. My stop-out level would be above this yellow horizontal line. And targets, you know, maybe the recent lows over here would have gotten there in a couple of days. So this idea of East, i.e. candles, and West, I think is a really powerful aspect to keep in mind when you're thinking about using your favorite Western techniques. Consider, I mean, I would still use them, but add candles. This is what the Japanese do, and this is what the really successful traders do. They use the candles as the final trigger. So in other words, they have a resistance area with the shooting star. This is actually a bearish signal here also. It's called the dark cloud cover, but we're not going to go into that today. But, you know, the point is that if you have a candle signal confirming a Western signal, you could think about becoming more aggressive on the trade because of this convergence of clues. East, as shown by the title, East plus West equals higher confidence. More confidence, the more aggressive you can become.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.